Welcome, aspiring traders and curious minds, to a journey through the financial landscapes of stock market trading and forex trading. In this video, we're breaking down the key differences between these two realms, making complex concepts simple for those venturing into the world of finance. Let's kick off our exploration by demystifying stock market trading. In simple terms, stock market trading involves buying and selling shares, or stocks, of publicly listed companies. When you own a share of a company, you become a shareholder, and your success is tied to the company's performance. In stock market trading, you're essentially buying a piece of ownership in a company. Your returns come from the company's profits and, potentially, stock price appreciation. Stocks are traded on stock exchanges like the New York Stock Exchange, NYSE, or NASDAQ. Companies go public by offering shares to the public through an initial public offering, IPO. Shareholders may have voting rights in major company decisions, depending on the type of shares they hold. Now, let's shift our focus to Forex trading, which stands for foreign exchange trading. In this arena, you're not trading ownership in companies but rather trading currencies. Forex trading involves the exchange of one currency for another. Currencies are traded in pairs, such as euro to US dollar, euro/US dollar, or US dollar to Japanese yen, US dollar/Japanese yen. Unlike stocks, Forex trading doesn't grant ownership in a company. Instead, it's about speculating on currency price movements. Forex trading often involves the use of leverage, allowing traders to control larger positions with a smaller amount of capital. However, this also increases risk. One notable difference between stock market trading and Forex trading lies in their operating hours. Stock markets generally have set operating hours, with trading taking place during specific sessions. For example, the NYSE operates from 9:30 a.m. to 4 p.m. Eastern Time. The Forex market, on the other hand, operates 24 hours a day, 5 days a week. This continuous nature allows traders to engage in Forex activities at almost any time. Liquidity, or how easily assets can be bought or sold, is a critical aspect in both stock market trading and Forex trading. Liquidity can vary among stocks. Major stocks and well-established companies often have high liquidity, ensuring that you can easily buy or sell shares without significant price impact. The Forex market is known for its high liquidity, especially in major currency pairs. This means that currency trades can be executed swiftly without major price fluctuations. Understanding the players in each market provides insights into how these financial ecosystems operate. In stock market trading, participants include individual investors, institutional investors, like mutual funds and pension funds, and high-frequency traders. Forex trading involves a diverse range of participants, from individual retail traders to large institutional players, central banks, and multinational corporations. Volatility, or the degree of variation in trading prices, is another factor to consider. Stocks can experience volatility based on company earnings, news events, and market sentiment. Individual stock prices may be influenced by company-specific factors. Forex markets can be influenced by economic indicators, geopolitical events, and interest rate decisions. Volatility is often driven by macroeconomic factors affecting entire economies. Both stock market trading and Forex trading involve different approaches to decision-making. Stock traders often rely on fundamental analysis, examining a company's financial health, earnings reports, and growth potential. Technical analysis, which involves studying price charts and patterns, is also widely used. Forex traders often emphasize macroeconomic factors and geopolitical events. Technical analysis remains crucial, with traders analyzing currency price charts for trends and patterns. Regulation and oversight play a vital role in maintaining market integrity and protecting investors. Stock markets are regulated by government agencies like the U.S. Securities and Exchange Commission, SEC. These agencies enforce rules to ensure fair and transparent markets. Forex markets are decentralized, and regulation varies by jurisdiction. Regulatory bodies, such as the Commodity Futures Trading Commission (CFTC) in the U.S., oversee Forex brokers and ensure market integrity. Understanding and managing risk is crucial in any form of trading. Stock traders often diversify their portfolios across different stocks and industries to spread risk. Stop-loss orders help limit potential losses. Forex traders use similar risk management tools, including setting stop-loss orders and carefully managing leverage to control risk exposure. In conclusion, whether you're drawn to the ownership stakes in companies offered by stock market trading or the speculative nature of currency exchange in Forex trading, both arenas have unique characteristics and opportunities. Each path requires a nuanced understanding of market dynamics, risk management, and decision-making strategies. Embark on your financial journey with a solid foundation of knowledge, and remember that continuous learning is the key to success in the dynamic world of trading. Whether you choose the stock market or Forex market, or both, may your ventures be informed, strategic, and rewarding.